And you drop bonds about 4 points below where they're trading right now. They're 115 T-bond futures March contract. And they could have a puke where yields shoot up again, breaks out of that zone of high rates and goes even higher. Price breaks through the floor of the last 3 years. That's when the Fed panics. Because, when mortgages broke, that was a crisis back in 2007 to 9. This time it's government debt crisis. Not just here, Japan, UK, a lot of places where they've got debt markets that are, something's wrong, and the governments know it, and they'll stop at no point of caution to save those assets, because those assets will implode the stock markets, the economies. This is a big issue for them. And while they've been buying bonds since November, you don't see any upside in the bond market. In fact, they're weakening. And I would be watching that market as a trigger that causes the stock market to say, forget about NVIDIA. Yeah, it's going to break and go down more ultimately. But the trigger could be in the government debt market. And the beneficiary of that's, of course, going to be gold and silver.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Michael Oliver. So Michael's the founder of Momentum Structural Analysis. Michael, thanks so much for coming back on the podcast.
And good to be
happy
back.
New Year.
Yeah.
Great. Yeah, looking forward to the conversation. It's been a really interesting last couple of months, but I'd really like to hear what you're currently seeing in the economy and markets at the moment.
Well, I think 2026 is going to be a very dynamic year for many markets, up or down. I think the monetary metals will continue up, but at an accelerated pace, particularly silver. I think it's going into a new reality. And by that, I mean, it's not just going to take, let me explain it one way. Most people look at a price chart and they have an arithmetic chart, meaning dollar, and so forth. Like if you look at silver going back 50 years, you have a range from like lows at $4 and highs at 50, stuck in a half-century range. Very few assets in the world have been stuck in that same half-century range, but silver has, for whatever reasons. I think we know some of the reasons. Gold hasn't been stuck in that kind of range. It has had 2 8-fold dimension moves, 76 low to 1980, 2001 low to 2011, both were 8-fold, well above the prior highs. But silver's been confined in the box. When you look at an arithmetic chart and you do your amateurish range objective, you've got a range from roughly, I call it 0 to 50, let's say, okay? Well, you're going to go to 100, and that would double the range. But when you put it on a logarithmic scale chart, a ratio scale, which I think is far more appropriate right now, that's a 10-fold dimension. In fact, our bare lows during that 50 years were $4 area. You went to 50, it's 10-fold, okay? From bottom to top. 10-fold above 50 is what? $500. If you backfit the price of gold by the degradation in the US dollar's buying power, or the yen's buying power, or the euro, whichever one, but we use the dollar, and you try to fit, where should the price be if it were at the 1980 high or the 2011 high, factoring in the degradation in the buying power of the dollar, or the increase in the money supply? You'd be a couple $100 easily. It's not unusual for markets when they make mistakes, and we know this about like bubble tops in the stock market, for example. When they go too far one way for too long, and then they break, often the downside overcompensates for the error in the prior overpricing. The same can be said when a market's been depressed too low, too long, and has in effect made a mistake or been confined. When the leashes come off, it often will compensate for it by going to the new reality, but it often will overshoot what you might say is a rational new reality, like, factoring in the price of silver balanced by the decay in the money supply. Maybe you overshoot that, and I wouldn't be shocked. But we've also done a lot of technical work at MSA based on a lot of other factors, but in particular importance is the spread or the relative performance relationship between monetary metals in the U.S. stock market. Divide gold into the price of the S&P and plot that chart over going back a dozen years. And you'll see there was a range that prevailed after gold collapsed in price and in relative value to the stock market. It collapsed down to roughly 50% of the price of the S&P. Either side of that for the last actually 11 years, since 2014. And that spread chart, when you plot it, is like a base after a big drop. You broke out of that base in November, relative performance gold to the S&P, and further in December. And when you plot that same chart, silver versus the S&P, you also broke out, except more gushingly. And then when you run a spread chart, a relative performance valuation chart of silver divided into the price of gold, take an ounce of silver divided into gold, express that as a percent. Back in 1979 to 80, silver was 6.5% of the price of gold per ounce. In the bull market that peaked in 2011, 2010 to 11 period, the spread surged up to 3.1% of the price of gold. The low early this year was down at 1% of the price of gold. So silver, while it was advancing since the 2015 bear low, just like gold had been advancing, was advancing far less. Therefore, its relative performance was anemic. Silver's now up to 1.7, I think, percent of the price of gold. So it surged massively. You buy something like at $100 and it goes to 170. That's like 1 to 1.7%. So it's surged a lot in the last few months, but it's broken out of a decade-wide spread chart base, where technically if you analyze the spread, forget the price of silver or gold, just the difference. Okay, you had this basing pattern, and silver has broken out in spades, exploded. That is a very important technical. Two prior examples of such spread breakouts where silver went from less underperformer to gold and had a basing type pattern and broke out. It exploded in price over the next couple quarters. Back in 1979 in the summer, as silver had already been in a bull market for a couple of years, and that's when silver went from like the teens to $50 in 5 months. Huge multiple gain. The spread breakout is the technical factor that told you, something's about to happen. You go over to the 2010 bull market, which had already been going up for years in silver and gold. But silver had been underperforming gold and had been caught with a ceiling on the spread chart. Bang, bang, couldn't get above it. In September of 2010, silver was about $20. And boom, it went up double and a half in the next 7 months from the price level it was when that spread broke out between September 2010 and April 2011, when again, it hit the top of the old price range. But the spread told you the game is changing. Silver's now an outperformer. And that's when the net price of silver went berserk, double and a half in 6 months. The situation here is the same, except even clearer. The base is bigger. Like I said, it was 10-year wide, where silver was confined versus gold. It broke out in November, and it broke out even another structure in December and exploded. Look what happened to the price of silver since November and since December compared to what happened to the price of gold. They both went up, but silver exploded. But if we set the clock again and assume that this could be a couple quarter process where silver goes, not only beats gold, but does so rapidly and causes price to go up a lot. Expect much of this to occur in the next 6 months since that November and December breakout, meaning sometime in the second quarter, perhaps. Don't be shocked if silver's several $100s an ounce. That's our expectation based on that analysis and some other factors as well. Yes, gold will have gone up during that time nicely, but silver will have beat it and regained perhaps even challenge the spread chart highs we saw in 1980, over 6%, and over 3% in 2011. Again, we're still below 2%. So that percent gain is enormous. And also factor in this fact, which few people note. Pardon me for being long-winded here. Gold, since its last bear market low in 2015, it was $1,050. It's fourfold gain at this point in time on a ratio scale basis. It's 4 times the price of that. The 1980 peak was 8-fold gain from its 1976 low. And the 2011 peak versus its prior bear low in 2001, a 10-year bull market then, was an 8-fold gain. If gold merely matches the ratio scale bull market that it had in 1980 and that it peaked in 2011, gold would be well over 8,000 just to match the dimension of the bull markets that occurred then. Imagine if silver's 2% or 3% or more of an $8,000 plus gold, assuming gold only matches what it's done twice before. So anyway, that's the dynamics I think we're facing in the monetary metals.
Yeah, a lot to unpack there. So I know silver currently is about $3 to $4 trillion total market cap. Do you think that could, obviously it's very different how it's measured, but then if it were to at least 5 times plus, that means $20 trillion. Do you see that as a concern, or is it not really how it's?
No, it's just silver catching up to a reality. But by the way, we've run studies in MSA for our subscribers that show some prior examples, and these aren't normal. I'll admit that. But when a market has made a mistake and stayed confined too long, and I'm talking about being depressed now, copper went through such a situation. If you go back and look at long-term copper charts back in 1970, 1980 to 1990 into about late 2005. So multi-decade range, copper was in a range from roughly 50 cents to $1.50. Back and forth and back and forth. That was its old reality. In late 2005, it broke out of that price reality. In a matter of a couple quarters, quadrupled in price, up to $4.50 an ounce, per pound. And lived in a new range after that. Oh yeah, it had some sell-offs after that explosion, but literally in the several quarters, it quadrupled. It didn't incrementally go up to a new reality, it exploded. Lead, a very dynamic market, was in a similar range-bound reality from those same years. And in 2007, a year and a half after what copper did, it also broke out of this multi-decade, very depressed range and went up, quadrupled in price in a couple quarters and lived in the new reality after that. Why has silver still been confined in that old reality that goes back into the 1970s? What is it, dirt? Or has it been contained by various measures? And we're not going to get into that issue except to say lead did it, copper did it, gold's done it. Why is silver contained in a 50-year range? When it breaks out, you think it's only going to go up the same arithmetic range, or is it going to do like a quadrupling like copper did or lead did? Or look where gold is now versus its 1980 high. It's $4,500 gold versus $850 high. Where's silver compared to its 1980 high? It was $50 then. It's 80 now. It's trivial compared to what the ratio scale move of those other markets have been ongoing. I think silver's going to catch up, and it's going to a new reality. And we know there's fundamentals behind it. The supply-demand situation for silver, industrial demand and supply, has been deficient for 5 years plus now, where there's just not enough supply to match the increasing industrial demand. High-tech industrial demand, solar panel creation, all these things are consuming a lot more silver than we produce. And despite the higher price, supply is not increasing, primarily because silver really doesn't come from silver miners. It comes from base metal miners. And so that silver price is not an incentive so much for them as it is the price of the underlying base metal that they're out to get. Anyway, those dynamics are now in play, and I think they're going to rapidly go to the new reality and probably even overshoot a rational new reality. And then there's also the other macro fundamental underlying silver. It is money. Don't forget that. And as gold rises, the monetary metal, silver is also monetary metal. Don't forget it, going back thousands of years. And as we get into government debt crisis problems, which we're on the cusp of now entering, our assessment, hence weakness in the stock market, it will follow that. Not necessarily dramatically in the first 6 months of this year, but probably later in 2026, we'll see some sharp stock market decline. Right now, frankly, I think the stock market is probably going to incrementally hold itself together and maybe even rally for another month or two. And any sharp decline, which I know a lot of silver and gold owners are fearful of because they think there's a correlation, and there's not. It's not a good correlation. That if the stock market drops sharply, so must gold, for example. But even that type of event, I don't think is going to happen until we get mid-year this coming year. And goodness knows where silver and gold might be at that point, especially given our analysis that in the next 6 months, we should have extreme drama. So again, there's not just the industrial demand, supply-demand problem for silver. It's the monetary underlying crisis that is out there and is not going to go away this time.
Yeah, lots of great points. And then, the miners have, especially gold miners, have sort of progressed in the coming months. And I guess, as you said, silver's a bit harder because it's really an off-product of other production. But do you expect all the miners to continue on their current run in a similar trajectory to what we've seen in the precious metals?
Gold miners are at a point now, when you go back in the 1980s, 70s, and 80s, see, XAU index is a good metric for that. It's gold and silver miners, XAU index, Philadelphia gold, silver index it's called, but it's actually miners. In the 1980s, 1990s, 2000, up till 2008, that index, if you divided it into the price of an ounce of gold, was in a range above and below 25% of the price of an ounce of gold. Divide XAU index into the ounce of gold. It had lows at around 17, 18% of the price of gold and highs 35%. So let's call it 25% is the median of that multi-decade range of relative valuation. In the 2008 through 2015 decline in the miners and relative performance, much of that in 2013, 14, and 15, as there was a bear market in gold and the miners then, the relative value of the miners dropped to 4% of the price, XAU, of the price of an ounce of gold. So you had something that lived in the median 25% level and went to 4%. And since then, since 2015, it's lived in a range, relative performance, of highs just above 8% and lows around 5%, with that extreme low at 4%. So very cheap range relative to its historic ratio to gold. It's pushing at the upper end of that range right now, where XAU index divided into an ounce of gold is now pressing toward the upper end of that basing pattern. If we see XAU index get up to about 8.6+% divided into an ounce of gold, right now it's 8.12, I think, 8.17, I think the last I checked. You clear the top of that range on that decade-wide basing pattern of relative performance valuation. You could gush that relative performance, you could double it just to bump the underneath side of that prior multi-decade range. In other words, when we break out on the XAU versus gold relative performance, not only will gold miners perform as well, but better than what gold is doing at that point. And they look ripe for that breakout. So in other words, at this phase in the gold bull market, while the miners have been firming from that 5% level now up to 8%, it's still very cheap. And if they break out of that range, you could see a gush in terms of relative performance. So I think in 2026, we're highly likely to see a point there, probably soon, where the miners say, enough, I'm unfairly valued. and they're going to gush meaning a better place to be actually than gold. Now, when we go into the gold and silver miners themselves and look inside of it, we can see that silver miners are still very depressed relative to gold miners. In fact, GDX right now, which is supposedly the gold miners ETF, but it's actually got some silver miners in it, but mostly gold miners. It's above its price level in 2011. It blew out above that old high, okay, finally. And it did it in a gush. Silver miners, SIL ETF, is only back up to its 2011 price highs, either side of $90. That's where it's trading right now. So it's been sold into in the last several weeks, just short of the highs it saw in 2011. The spread relationship, relative performance with silver miners and gold miners looks like it's ready. In fact, is starting to break out relative to gold miners. So if I were to again shift that issue, should I own gold or miners? Yes, you should own more miners, I think. You emphasize that component of the monetary metals. But within the miners, I would focus on silver miners. So just like focusing on preferring silver to gold, I would prefer silver miners to gold miners.
Yeah, great. Thanks for unpacking that. So if we go to sort of the rest of the equities markets, I guess US didn't outperform last year, but it still did quite strong last year. A lot of the other global markets did quite well, Europe, UK, Japan, etc. How do you see them moving into 2026? Do you still think they're at risk?
Our assessment is they're making topping patterns, not evident on price charts. But if you go back and do your history, you'll notice that, for example, in 2000, .com top, which led to a 50% collapse by 2002 in the S&P and an 82% collapse in the leading sector, the NASDAQ 100, which was the leader at .com stocks, internet stocks back then. That topping process took a full year. In fact, MSA issued a major be gone signal in January of 2000, and it labored both sides of that price level for a year. Higher than that level in price and lower than that level, but basically boring but steady, including a new high in the summer of 2000 that was higher than where we said get out in January by about 10 or so %. But it didn't go down until you got really, basically after the first quarter of 2001, it really started to come apart. So in other words, you had a laborious top, and yet it was topping by our momentum metrics. It said it's over, price may linger, but as far as an investment perspective, this guy's topping. 2007, same scenario. It was in December of 2006 that we put out a report projecting for the next year that the S&P then was like 1,400 at the close of 2006. We said next year, expect the high to be, we have target top range between 1,550 and 1,600, meaning a substantial further gain from 1,400 up to 1,550. And it got up to 1,550 plus in the spring, I think, of 2007, and had a collapse into the summer. It hit our numbers, got barely into our target zone. It got up to 1,555, I think. So 5 points into our target range and dropped hard. And then it came back up in August and September. And in mid-September, it was approaching the old highs again, meaning the 1,550 level. And the Fed cut rates. It was a surprise rate cut, 0.5 point. And blew the S&P through that old high of 1,555. Which also had been the price high in 2000. Its peak then was like 1,553. So call 1,550 the high in 2000 and the early high in 2007. And with that Fed cut, they blew out those two highs. So if you're looking at a price chart, you say, oh boy, a triple top breakout. The Fed's going to cut rates. Everything's great. You should have shorted it right there. The high was 1,573, I think it was, in October. And it dropped, didn't collapse. The collapse didn't really come till late summer of 2008, so almost a full year off the October 2007 high. But anyway, that was a laborious top also. It spanned a full year. What have we done? We made our high in January, February of this year, past year. and we're almost a year old, and we're about 10 or 15, we're about 15% above what had been the high in January, February, which is just below 6,200 on the S&P. Right now, we're in the mid 6,900s. So it's been further gain, but it's been really incremental. Once we took out that high back this summer, we crawled higher. We didn't explode. But I think we have an aging and maturing topping process in the U.S. stock market. And this is true with certain of these other bubble markets. Japan is also what we would call a bubble stock market. India is also one. China is definitely not a bubble market. Its price is only trading 1.5 times the price level that it traded at the 2009 bear low. So yes, it's higher, but it's not 10-fold or 20-fold that price like the S&P and the NASDAQ are. Europe is midterm bubble. It's not the same dimensions as the US compared to where it was in 2009. But we do have some bubble markets out there in terms of age, overpricing, and technical vulnerability. So I think it's going to be a global downside event, with the weaker ones being what are the stronger ones now. That'd be the US, probably India, and Japan. And we know that in the case of Japan and the US, we have a government debt crisis as well to add fuel to that implosion, which means what happens when that occurs? The central banks go berserk. They print money, they do QEs, they do whatever they can to save their bond markets and their stock markets. But that money doesn't work in that way. Yes, they create more money and it goes somewhere. It's always gone to gold, monetary metals. But it won't help the stock market because they cut rates from 2001 all the way down to 2002. The bear market continued in stocks, and they cut rates in late 2007 all the way down through 2009 and further, and the stock market still imploded. It doesn't help, but it does create money, which creates further fuel for the gold market.
Yeah, so it's interesting because a lot of people think this debasement trade, as you said, they're going to have to throw money, as much money as possible. They're already printing a lot at the moment. They're going to have to throw more into the economy and markets to save it. A lot of people think that will benefit majority of assets, but you see it mainly being a gold and silver phenomenon.
I don't think it'll help the stock market because it hasn't in the past. And I also don't think that if you're long gold or silver, that you should be panicked about a stock market drop. There was that one instance back in 2008 where we had a very bad month in gold that participated with the S&P having a very bad month. That was already a year off the high in the stock market before gold finally had a bad month. And then gold immediately turned around and started making new highs again. The Fed at that point, after that October collapse in 2008, full year after the high in October 2007, went to QE and went very aggressive. What was the immediate beneficiary was gold. It immediately turned and went back to its highs and the new highs. S&P continued down until March of 2009. So again, I don't think the stock market will appreciate or be helped by increase in money supply.
Okay, makes sense. And is there anything that you think is extremely undervalued?
Yes.
Okay.
Another investment arena to be looking at closely is commodities in general and stocks related to commodities. Right now, the weakest component of the commodity sector, Bloomberg Commodity Index, for example, is the energy sector, crude oil in particular, gasoline and heating oil. And natural gas is buoyed quite a bit, but oil is the weak component. But the Bloomberg Commodity Index broadly does correlate well to oil. Oil correlates well to the Bloomberg, not month to month, but in major swings anyway. And the Bloomberg has broken out by our metrics into what is going to be the second up leg of a still very cheap asset category. Remember, in 2008, the Bloomberg Commodity Index, which is now at 113 in rally mode, was 237. So we're half the price, less than half the price of where, half the price of where we were in 2008. And in 2011, it made a secondary high at 170, and we're at 113. So historically, just looking at the Bloomberg versus itself, it's still cheap, okay? And it got to a ridiculous low in mid 2020. It traded down into the 50s. I don't know what people thought at that point. Like, is it going to go to be free? You know, we're going to have free grains, free sugar, free oil, you know, whatever. Anyway, and it exploded from there. And we called this trade in October of 2020, and it doubled and went up to 140 in that surge. But when that war started, opposite to what most people might think, the Ukraine-Russia war, commodities went down. So did oil. You think, well, that should be bullish for oil, right? No, it wasn't. Oil went down, and oil is now down below 60. It's very quiet, very depressed. It looks like heck. You know, who wants to own that? Our momentum studies of oil argue, and again, it's the weak component in the Bloomberg, that not too far, and I won't be specific here because we tell our subscribers exactly what number, but it wouldn't take but a handful of percentage points above where oil is now trading to break it out on long-term momentum metrics, not on the price chart. If you look at a price chart, our trigger level wouldn't provoke people into buying it. But momentum says you break out through that, you're going to go. You're going to go up. And so while we have a lot of news about oil right now that people are trying to interpret one way or the other, and it's remaining depressed, and we know the administration wants to keep it down because they made a promise that gasoline will stay cheap, as other things that they haven't stayed cheap, but gasoline has. We see a situation there technically that looks very ripe for oil to turn up sharply. And I don't know that you're going to need a headline excuse to do it. It's a matter of cheapness compared to its old historic price levels. 140, then a bull peak at 130, and we're trading, what, 57, 58? Okay, that's not like, you know, it's overpriced. And when you factor in the price of oil into the price of gold, for example, it's off the page historic cheap. You divide the price of oil into the S&P 500, it's off the page cheap. What do you think it's going to do? Go to zero? So I think that there's probably a resurrection even in the oil complex. And the oil stocks are not quite behaving like oil is. They don't look so depressed. Some of them do. But XLE is hanging around near higher levels, like it knows this isn't going down. There's some of the sectors within oil that look cheap. But broadly speaking, I would say from an investment perspective, something you want to buy and hold for several years, not a trade. I think looking hard now at commodity-based stock sectors, and there are some ETFs in this regard, MOO, for example, a lot of fertilizer stocks and other grain, agricultural-related companies. Base metal miners, XME is a good example of an ETF that does have a few gold miners in it, but primarily it's base metal miners. And look at copper, it looks quite good, very strong, making historic new highs now. And others some base metals as well. And also watch the oil sector, because I think if that oil hits our trigger number, which will surprise people, and then shoots up after that, which I would expect, you're going to get a sudden awareness in some of these cheaper oil sectors like OIH, XOP, ETFs that hold not the primary oil producers, but other companies. So I think that's a good investment arena to be looking at. I don't think it's going to match what happens to the monetary metals, but I do think it's a good one, cheap, low risk area to be in, and has a good dimensionality of upside ahead of it. And it can go up despite the stock market going down. They're not well correlated to stock market moves, these sectors. So you could have a bear market in the stock market and those sectors go up. Anyway, that's another place I'd be looking.
Yeah, great. And, I guess a major trend in 2025 was sort of the AI boom, the AI bubble. I'm assuming you've mentioned S&P and NASDAQ that you think they're going to come down. I'm guessing you think the AI bubble could sort of burst as well.
Yeah, I think the AI bubble will break, but I think right now everybody watching it is we're not watching the primary trigger. Ultimately, the leader on the upside will lead the downside. And right now what's going on with AI is stability. If you'll notice, while the S&P is at new highs, NASDAQ isn't, NASDAQ 100, but especially some of the AI stocks are definitely not back to their highs. Yes, they firmed recently, and they're likely to stay steady, I think, or maybe even firm a bit more over the next couple of months. But they're not making new highs, so there's a divergence there. The same thing happened back at the dot-com top. When the S&P later in 2000, after we said sell in January, by August, it made a new high monthly close. NASDAQ 100 didn't. No, NASDAQ wasn't collapsing, but it didn't make new highs. So it was a deviation between the leadership and that. But what's likely to spark the downside, I think, in the S&P now is not so much the focus on does NVIDIA break, okay? Yes, it's likely to break, but you should be looking at outside factors that are huge. Two of them would be the dollar index, which we regard as already being in a bear trend, but paused recently, last 6 months, in fact, anemic as heck, but broken, anemic, but likely to go down more sharply. When that occurs, that'll be a big event. Right now, you can call it the quiet one. And the U.S. Treasury bond market, long end of the debt market, 30-year bond futures. Right now, the T-bond futures had a collapse between the 2020 price high and the October 2022 low. T-bond futures went from 190 down to 117, much of it occurring in a collapse phase in 2022. But since then, they've tried to bottom, meaning yields have tried to stop going up on the 30-year. They've not. They've stayed stable, but at high choking interest rate levels, despite short-term rate cuts. The long-term end has not gone down in rates or gone up in price of bonds. Right now, T-bond futures are trading at 115. So for 3+ years since that October 2022 low in price, they're still below that low. They've tried to rally repeatedly. In fact, there's been 3 major efforts to rally. And they get off the ground, but then they go oomph, right back down. So no wonder one of the major brokerage firms a few months ago said, hey, it's time to rethink the 60-40 principle of portfolio allocation. 60% stocks, 40% bonds. It should now be 60-20-20, 20 being gold. At least that was an admission that something's wrong in that bond market. And I think the Fed knows it because the head of the Fed of New York, a guy named Williams, a month or so ago said, I think it was mid-November, that the Fed is now going to, quote, start buying bonds. And he said the reason for that, he didn't say it's because, we're afraid they're going to collapse. But he said, for liquidity purposes. Oh, that's great. Just liquidity. No problem. Okay. They've been buying bonds for a couple of months, as evident. And the bond market hasn't gone up. In fact, it's lower than it was a couple of months ago when he said that. It's not collapsing. It's steady, but it's anemic. And you drop bonds about 4 points below where they're trading right now. They're 115, T-bond futures, March contract. And they could have a puke where yields shoot up again, breaks out of that zone of high rates and goes even higher. Price breaks through the floor of the last 3 years. That's when the Fed panics. Because, when mortgages broke, that was a crisis back in 2007 to 9. This time it's government debt crisis. Not just here, Japan, UK, a lot of places where they've got debt markets that are, something's wrong and the governments know it. And they'll stop at no point of caution to save those assets because those assets will implode the stock markets, the economies. This is a big issue for them. And while they've been buying bonds since November, you don't see any upside in the bond market. In fact, they're weakening. And I would be watching that market as a trigger that causes the stock market to say, forget about NVIDIA. Yeah, it's going to break and go down more ultimately. But the trigger could be in the government debt market. And the beneficiary of that's, of course, going to be gold and silver.
Yeah, really important. So, Michael, thanks so much for your time today. We sort of covered lots of different areas. But my last question is, what is one message you want people to take away from our conversation?
You can go to our site and read about our very unorthodox methodology, technical methodology. We've been around since 1992. We've got both institutional clients and funds, banks, et cetera, and family offices, but also private subscribers. And we cover all 4 asset categories. In other words, you can't just look at gold and silver and do that, because you'll miss what's going on in these other markets that will have an impact. Fuel for gold, in fact, like what's going on in the dollar index versus other pieces of paper, what's going on in the U.S. government bond market or Japanese market, and so forth, and also the stock markets, and also broadly the commodities, because these four asset categories aren't going to go together. We argue that you're likely to see real world assets, not just monetary metals, but stuff under the ground and above the surface, go up as well when the government prints the money, and it will not save their paper assets. So that's what we do. Consider subscribing and ask for some sample reports. Oliver MSA is the site, Oliver MSA.
Great. I'll put a description below, but thanks again for your time.
Thank you, Anthony.